So anyway, let's go back into this. So what is report generate? What I really wanted to show you is the fact that it really leads on from the ideas that were shown in the previous talk, because here we're concerned with taking data and generating reports. So if unfortunately I don't have the finance platform here in this version, in this computer to show you. However, if I did, it would show you that there is a function built in called structure gather, which basically does many of the things that the data array functions were doing or will be doing in version 10, that allow you to take in tabular data and rearrange it so that it's in a hierarchical structure. So what exactly do I mean by that? So what I've got here, let me just put this into, I can't even show it in, oh yeah. We should be able to, yeah, so basically I've written a fair amount of code, it's loaded in some package. The purpose of this code, it really doesn't do anything much other than drag in data from financial data. For those who are more serious, it also, you can drag in data using the Bloomberg link. And what I wanted to be able to show is that you can set this up in such a way that you can, generate financial reports. So what are financial reports? I doubt whether this is going to work now. I can't actually get this thing to go. Let's have a look whether it does this.
Are you looking for a documentation for financials?
I need something that's got the WFP.
Just send you an email that has a link for online, so you can get the documentation.
By the time we, okay. So none of this will evaluate. So basically, if I just go in here, back to the, just shrink this down for the moment. And have a look here. So basically, let's have a look at the templates. I don't know whether this is how this is going to come out. Oh, okay, all right. So what we can see here is this is a sort of typical template that would generate a report. And what I wanted you to do was to look at how the code actually looks. So here, for instance, is the corresponding Mathematica code. So what you do is you set up an instance where you're looking at a particular firm and you want to get to generate a report about some aspect of that firm. In this particular case, I'm looking at, say, General Electric, and I want to look at various aspects of its properties. So I want to look at the daily price, long-term trends, fundamentals, and the rest. And I then set up a tab that allows me to look at all of these properties, and then I'll generate a number of graphs. Okay, so I'm going to be looking at graphs for the high, the low, the close, and the return. This is the normal code as you would write it in Mathematica. So how do I then turn this code into a template that will allow me to generate a report? So what will happen here is that I then create a template using, there's a template whiz or report generate whiz that allows you to do this. And let me just show you then the template. So it's the same type of code, except you'll notice now that instead of having General Electric, I've put in a template variable called ticker. And what ticker does is that I can now replace this by any type of company ticker that I wish. And you'll notice also that there's a schema up above. So this is very much in keeping with the sort of data array structures that were shown in the previous talk. What we've got is more or less company is a pointer and an association. I can change whatever the company might be, and then I associate with that particular company its name and its ticker. So then I can set up a whole array of companies, and this same evaluation will now be done across that data array. So ticker, everywhere you see it, will now be replaced by whatever company ticker I want to put in, General Electric, Apple, Microsoft, whatever. And I can also identify the name, and it will then just generate this type of report, but with all of the values substituted in. Okay, so when you go to the thing here, all I have to do then is enter it in the following manner. We've got report generate. I say go and find the template which will generate the report, and then I give it the data to put in. So you'll notice now that company is what's called a template group. It's more or less the associative key that says that there's now going to be a class of objects, namely companies. And for each of these, I will identify two aspects, their name and their ticker symbol. So in this particular case, I've got General Electric and Apple. And I put those in, and we now get the following type of report. Okay, where is this thing? Here. Okay, and this thing is automatically generated as a result. So you'll see now that I've got two companies, General Electric and Apple. And it then generates the daily prices, the log-term trends, the fundamentals, the earnings, the raw daily prices, the dividends, and I asked it to also put up the high, low, close, and everything. And you'll notice that it's also substituted in the name. So it was only a tiny piece of code there. And with it, I was able to then generate this. It would have only taken a few seconds, depending upon the strength of your connectivity. But it's a rather simple thing to do. And in the same way, I then generated it for Apple. Now, you could do this for your portfolios or anything. And all of the examples that I've got here are of the same type of structure. So again, if we go back down here, and we're going to look at the second template, and I also want to look at the, so if we look at the actual code, in this one here, I'm going to generate a report which is going to compare a number of stocks and rank them. So this would be for the purpose of analysing for portfolios. Basically, I'm looking at a sort of mean variance analysis. So I'm looking at their mean and standard deviation and their performance. So here we can see the actual code itself. Again, so basically here I've got the stocks to be analysed. I write in all of the stocks that I want to look at, and I extract their name. This goes as a header up the top, and then this is then followed by a function which I've written which just basically does a very simple analysis. It compares them across a number of criteria. And again, I put in the same list. And I can also identify the number of days or history that I want it to go back and look at. So there's only two variables here, namely the list of stocks and the number of days of past history that I want to examine. So when we go and look at that, this is now what the template looks like. Okay, so I've got it here. There's what's called an expression variable. So a valuation expression. So I've put in two things here that says, okay, come back and tell me the date at which the report was generated, the name of the person who generated it. In this case, it's the username, which is just going to be Wolfram on this computer. And then I've substituted in here for another template variable, stocks, and yet another template variable, days. And you can see how here that there is no overall reference or group variable. They're each standalone variables, and so they just come in this list here. The schema here doesn't need to have a tag. So what does that output look like? Okay, we can look at it down here, and we've got, and this is the type of report that's generated. So you can see everything now is being substituted in by actual values. Here's a list of the stocks that we're going to look at. The S&P, and indices, S&P 100, 500, the Nikkei, the FTSE, and so on. And I then rank them. I've got all of the main statistical analysis here, and then I've got the means and standard deviations. So the means are ranked in a decreasing order, and the standard deviations in increasing order. So basically Google has the best mean, and the SP100 has the smallest volatility. But more than that, I can then go in for each of these and look at their probability density. It tells me about their behavior over the last period of days. And that was one of the other things that you could change. And as we go in here, it will then tell us for each of the bins what is the probability of falling within that particular range. So you can see at a glance how those various stocks and indices behave, their probability densities, and their general statistical analysis. Another example I've got here would be looking at daily ranges and trend lines for stocks. Again, the code's very straightforward. Okay, so I've just got one instance, say General Electric here, and the number of days, and basically there's just two functions that I call here. So one looks at the behavior over each day, and then generates box whisker plots about that. And then the second one then will set up a date list plot for a number of what would be the possible probability ranges for the actual path that's been observed by looking at its PDF. And I put these sort of confidence levels in here. So what does that then look like when we go and look at the template? Okay, so where are we? Again, what I've got is a group variable, a template group that has two underlying template variables, the ticker and the name, as well as two other things like I want a daily range for each of the days, and also how many days to look at going back in history for the trend lines. And you can see that these are each substituted in. So it's the same code that you saw beforehand, but now all I've done is replace it by the corresponding template variables, and such as name and ticker and so on. So now we can then generate the actual report. Okay, if you go and look at so let's just look at the report. But before we do so, I just want to also just show you how easy it is to call these things. So back here, this is the actual line of code that would then generate it. Okay, so I'd come in here and I'd say, well, I want to look at how is the behavior of the daily range over the last 365 days, but for the trend lines, I only want to look at the behavior over the last 2 months. And then we're going to look at 3 companies, General Electric, Apple, and Google. Okay, and this is the type of report that's then generated. Okay, so each of them, there's a report really for each of these companies. And what we've got is General Electric here. And you can see here's the box whisker plot for each of the days. Why would you do this type of analysis? Well, basically, if you're a trader, you're most interested in trading on certain days as opposed to others. It's really a waste of your time to try to trade when there's a very tight behavior of the stock. You really want to take advantage of the large variability. And so here I've got a breakdown of what happens for each of these stocks over on a day-to-day basis. And then it gives you all of the statistical data for the behavior of General Electric on Mondays, Tuesdays, Wednesdays, and so on. And so you can see here that Wednesdays and Fridays are really good days to trade for each of these. And furthermore, we can get an idea, this is the actual behavior, and these are the probability ranges or the trend lines associated with the behavior of the stock. So you can see that it's actually been performing well and is actually at the moment 5% above its mean performance. And the same type of thing can be done with Apple. Okay, Monday and Friday seems to be good days to trade with Apple. And again, it also is around 5% above its mean performance. So another type of analysis that is to look at stocks, and then again for the purposes of trading, look at their candlestick and trend charts, such as the Renko charts. I've got a list of them here. So here's the code. I'm using financial data, which is built into Mathematica, and it gives you delayed financial data that Wolfram Research collates and curates. And as you can see here, the code is only looking at one company. I take into account that sometimes financial data says that there's something missing there and we don't want the whole program to fall over because of that. So I say if it comes across the case that it's missing, then go and do the following, substitute in the ticker for the name and so on. And then I look at its behavior for the Kagi chart, the Renko chart, and I can also specify the levels of sensitivity that you need for each of these charts. And then I put it into one large graphics grid. So how does the template look for this? Okay, so we need you can see here that now what I've done is replace every instance where I had just one ticker symbol by this template variable. Again, because I'm going to have both tickers and names, I want to group them together into a collection of classes, and I give that class name company, but also the number of days of the previous history that I want to analyze. That's going to be a standalone template variable called days. Then when I go into to generate it, okay, here's the generator. It's just this small piece of code that says go and look up the template, substitute in wherever I see days, 365, and then look at the behavior for General Electric, Apple, and Google. Okay, and so we've got that. We want to look at the report for that. Okay, and so here's General Electric. Okay, and you can see that I can put in all of the specification for all of the variables now in each of the charts, so that it says here's the name of the company. Okay, we're looking at a particular chart over this previous history, and each of these charts offers different ways of analysing the behaviour of the stock. Each of them tells us about underlying patterns in the behaviour. And in fact, when you go in here, it will actually tell you the periods over which it's observing has a particular pattern behaviour. So it was going down, over this period, or it was going up over this period, and so on. And the same type of thing here. And so I can now generate all of this for each of the companies. And I will substitute in all of the names and the components. And let me so you can do other things like looking at delta gamma hedges. Often when you are building up a portfolio, what you want to do is replicate the behavior of some stocks. And the way to do this is called delta gamma hedging. So what you do is you look at both the delta, which is the first order change in the behavior of some corresponding option, and the gamma, which is the second order change, and you take a linear combination of this to try to replicate the behavior of the stock. So what I want to do then is look at the stock and look at, say, we want to be able to choose, say, a collection of options and see how well they replicate the behavior of a stock, because options are cheaper to buy than the stock itself. So you can still get the same profit, but instead of spending a lot more money and buying the underlying stock, what you do is you just buy an option on that stock. Okay, so here's the code. Again, you notice it's for a particular company. I'm looking at the close, the dividend yield, and the volatility, and then I feed that in to our financial derivative function, and I then build this simple function which just builds up the gamma delta hedge around it. Okay, and I then look at the behavior, how well a collection we could have a very large collection here, but I've just specified things like the American call and put, the future call, the future put, the perpetual American call, the perpetual American put, and we can then see for each of these how well they behave. When I want to generate it, I then, well, let's first look at the code again, the template. Okay, so this is number 5. We need to look at the template. And here we can see the schema again. Again, I've got this idea that for each company, we're going to have a class of companies. So this will be a template group. Everything else is going to be template variables. Ticker and name are associated or tagged to the template group. And I now substitute in all of these, replace them by each of these symbols. And when I run the thing, okay, we're going to get the report. Okay, so here, for instance, is General Electric, and I basically want to simulate its behaviour over a small area of the range of its most common values that it takes. And so what you're seeing here is the value that the stock takes, and I'm looking at a delta hedge, which is a first order approximation. That's usually going to be this straight line here, and the delta gamma hedge, which is a second order approximation, and you can see that it's the slightly curved line. So you can see at a glance how well they perform, and then I've got the output here, which looks at the range of prices, looks at how many shares I'd have to sell short for the delta neutral portfolio approximation. Here's the error involved, and you can see the error involved in a delta gamma tracking is much smaller. Okay, so just for General Electric then, I go through and look at a range of other options and how well. So we can see here, for instance, that a future European call works really well, whereas a put doesn't. A perpetual call works really well, and a perpetual American put works extremely well. The overlapping here is so good that the tracking error should be 0 or next to 0. And we can do the same type of analysis for Apple and so on, and all the way down here to Microsoft. Okay, so the code itself was very straightforward, and then all I did was replace any of the parameters in the original piece of code with template variables, and it then went off, accessed the data, and generated this report basically in a matter of seconds, depending upon how good your connectivity is. So I guess that's enough. I've got other examples as well. But I think the general idea that you can see is it really builds upon 2 ideas. The first is the ideas that were presented previously by Tracy, where he was looking at how you build up data arrays. Okay, so we're building up this whole structure of data science because we have to immediately come up against this concept that if you want to generate reports or do a sort of meta-analysis, then you have to have a way of turning tabular data into hierarchical structures. And so that whole notion is built into the finance platform, and there's a function that's called structure gather. Some of you might be familiar that there's a function in Mathematica called gather and gather by that basically allows you to zip through some data and then collect together as you pass through the data all those elements that have the same type of structure. It's a very powerful function. So we want to use the same idea when we're collecting data, but we want to collect them according to either some criterion or basically where they occur in various columns. So this is the idea that's then used by the report generator to build up the data array that allows you to then represent with using these type of schemas. If we go here and look at the template, you'll see at the top the representation of the schema gives this sort of meta-analysis of how the data that's coming into the report should be arranged. Once you've done that, then the report can then generate it in a way that'll take into account that there are different companies, and for each of these companies we're looking at different aspects of them. And then you just write your normal piece of Mathematica code that would look at just one instance for each of these variables, and then turn these variables into template variables, and it will then generate a whole report for a whole list of things all at once. So it makes report generation easier. It takes a little while to wrap your mind around this, but once you've done so, it's worth the effort, because it will do basically, what would have usually taken several days normally to put together can be done in just a couple of minutes. So it's a really efficient way to report material to your managers and to fellow workers, and also for your own analysis if you're interested in trading and other aspects of finance. So I'm sorry that the whole thing, my computer died, but well, these things happen. So are there any questions? Is there something I can answer? Yeah.
Is it possible to put like sliders in the report?
Yes, absolutely. Unfortunately, they didn't give me a computer that's got the finance platform on it, so I can't show you that. But yes, you can put in manipulate examples as well. And it's exactly the same type of thing. In fact, that's a really good question, because manipulate, basically, it treats all of the variables at the same level, as it were. It doesn't distinguish that there might be collections of variables that report to one association or one tag. So there is, in transforming from a piece of Mathematica code for manipulate and then converting that into, a report, it can be just a tiny bit tricky, because, you'd have to say, oh, well, I'd like to collect it according to, this particular variable is now going to be the group variable, and everything else is going to be subsidiary to it. But other than that small change, you can easily do it, yeah. And there is an example in the report generation documentation that does give one example of this. Are there any other questions? Yes?
Can we use the pre-scheduled task and send mail?
Absolutely, yeah. That's another really good thing. Thanks. I mean, I'm glad everyone's doing homework, making it easier for me. So yes, this makes it easy then to, so you can have you can identify a scheduled task, and then there are two functions in Mathematica. You identify what is a particular task. In this case, the task would be to run the report generation. And then you call up another function which says run scheduled task, and tell it when it's going to do this. You can either specify a particular time, or you could say some type of periodic behavior, like, yes, I want these reports generated, say, twice a day, say 6:30 after everyone's come in and the market's just opened, so we just want a review of what happened over the last week or so, and then again, towards the late afternoon, so we can get a sort of closing out strategy. That's, yeah. So beforehand, when I actually worked in the markets, I used to do something like that, but I had to use the create document function, and that was a lot fussier, and you had to fool around with graphics objects and heaven knows what else, and then I'd then send an email out to the traders, and they would get this report and they could look at it. So yes, you can use that, and that's an optimal way of using the whole technology. Sorry, yeah, you were going to ask a question.
So the delta gamma hedging function, that's part of the finance?
No, this is just a little thing I've written up. It actually comes up in the, I wonder if it's, because I was noticing there's some change, they've made a lot of changes to Wolfram Alpha. But if we go back here, so where are we? Okay, so let's just go back into Wolfram here, and there's Wolfram Alpha. Okay, you might have noticed that you can write in, things like, just say, Microsoft, Apple, Google, something like that, and just say, God, Internet Explorer is the most annoying thing. And then it'll come back and it will tell you things like, basically it'll look at the fundamentals, and you can choose from the various fundamentals. But so myself and Ed wrote this piece of code that's used in the Wolfram Alpha. So here's its past history, and you can choose whether you look at the last year or anything up to the last 5 years. And now what you can see it's doing is it's looking at the performance comparisons. And so not only the three stocks that I chose, but it's now looking at an index, the S&P 500. It's looking at long-term bonds, and it's looking at short-term treasury bills. And the reason it's doing this is it's now going to build a mean variance portfolio for you. Okay? So it does this. It looks at the correlation matrix between all of these, does a prediction, and then here is the mean variance portfolio with the weights associated with each of them. So this is a really powerful, and I've written another demonstration where I extract this thing out and show you how to use it. So that's actually in one of a talk that you can find online. When you go and look up Wolfram Alpha, you go and look up the finance platform. It's called Financial Visualization. But yeah, I think there's the delta gamma hedging. If you call up options, I think it might be within Wolfram Alpha. Just see financial option. It allows you to specify the type of option that you want. There's all of these various other options, and it gives you sensitivities analysis, looks at the prices. So there is a delta gamma tracking error involved. So we'll look at if I want to replicate the behavior, because this is part of the idea behind, I know. So, this is part of the idea behind option pricing, that you're really building up a portfolio, and it's a linear combination of the portfolio that'll allow you to mimic the behavior of the underlying stock. When you take the difference, the errors, the statistical variation should disappear. And that's the hope, that it does so in theory, yes. Yeah. Over very short periods of time where there's absolutely no trading costs, and we live in the perfect world that we don't actually live in. But yeah, that's the theory. Okay, I have to wrap it up. I'm being told quite vociferously, and lots of symbols behind that. That's it. But anyway, thanks very much for persisting with this failed thing.